Hello and welcome. This is Professor Spark, and today I'm going to walk you through selected topics from Chapter 6. I want to remind you that ACC is going to only cover selected topics, so you are responsible to read the entire chapter, take notes on it, to work through it, and seek help in the tutoring center or through myself during office hours if you are having trouble understanding something. You should take notes and create some flashcards, and once you are completed with all the material from the chapter, you do want to spend the appropriate amount of hours actually just learning the material through self-quizzing or some practice problems. Okay, and these handouts that you can print out through Blackboard are always really great tools for practicing. Even though they're simple problems that we've already covered, practice them again. Your brain working from start to finish without looking at notes is always a good activity for practicing. Chapter 6 focuses on 3 different areas: internal controls, petty cash, and bank recs. We are not going to cover internal controls very heavily. You can read through that. That's conceptual material that you can learn on your own. But we are going to focus on petty cash and bank reconciliations. Okay, internal controls, the purpose basically is to protect assets. So we're protecting cash and our inventory and equipment, things like computers, okay, from theft or error. We're ensuring reliable accounting. We want to make sure that our records are accurate, so our financial statements to our external parties will be accurate. We want to promote efficient operations. We want to make sure that the companies are doing things, or the employees are doing things efficiently and effectively, and that they're adhering to company policies. And I'm going to let you read about it, but Sarbanes-Oxley basically brought a lot of emphasis to internal controls and made sure that everybody became responsible for internal controls. Okay, back in the day, when there was some pretty severe fraud uncovered, the companies were saying, you know what, I thought that the accountants were doing it. The accountants were saying, but I thought the management was responsible for internal control. So everybody was kind of tossing up their hands and saying, but I thought the other person was doing it. So Sarbanes-Oxley came in and basically set down some standards that said everybody's responsible for internal controls. Okay. The second topic that we're going to really focus on here is petty cash. So petty cash, I like to tell students, that's kind of like a locked box, like a little tin box that has a lock on it that has actual dollars in it. One of the internal controls that you'll read about is the fact that companies should never pay cash unless they absolutely have to. Every expense should be paid for through a check or electronic debit. Okay? We don't ever want to actually pay cash, but sometimes we have to. So the company cashier will go ahead and write a check out of the general fund and assign a petty cashier to be in charge of this box of cash. Okay? Then throughout the month, employees can say, you know what, I have to go run over to the post office and mail something, return receipt, and I need some cash to do it, because the company cashier is not going to give you a blank check to go run to the post office. Okay? So what happens is the petty cashier says, okay, go ahead and sign out. You have to sign an official form to sign out a few dollars. They would give the money to this employee. The employee would go to the post office, pay for the item to be mailed, get a receipt, and return any change. They would come back to the petty cashier, say, here's my receipt, here's my change. They would go ahead and sign the forms a second time. Okay, that's a little voucher. It's a formal voucher. And everybody would move along. Okay, so petty cash is used for a lot of small items. For example, one item that it might pay for is, let's say our ink cartridge in our printer ran out, and we don't have time to wait for the shipment that comes at 1 o'clock in the afternoon. We would run over to office supplies and use a little bit of petty cash for that. Another thing might be to grab a newspaper if we need some documentation out of the paper. It might be to grab donuts for the employees if it was an appreciation day. Hey, little tiny purchases where it's not really reasonable to get a check for it. So throughout the period, the month, the week, whatever it is, the time frame, we would go ahead and assign the petty cashier to be responsible for this cash, to be responsible for getting receipts and vouchers signed. At the end of the period then, the petty cashier would reconcile and send a request back to the petty cashier that says, you know, I need X dollars to replenish my balance. The accountant would be responsible for the journal entries, and we're going to focus on the journal entries. We're going to focus on the accountant's role in this. Okay, so starting a petty cash fund. XYZ company starts a petty cash fund of $200. But what's really happening here is you're taking a general cash check to the bank and you're getting physical cash. Okay, so what we're going to do is we're going to take money out of the general account, so decrease to the general cash, and we're going to start a brand new cash account called petty cash. And that's an asset account, just like cash is, and we would increase the petty cash account. So what we're doing is we're separating out our general cash from our petty cash. It's kind of like getting an allowance, right? If you get paid on Fridays and maybe every Friday you take out $30 for yourself, okay? That's allocating the money, right? Keeping it separate. Now I've got $30 cash to go spend on whatever. Okay, so petty cash, separate account, and cash gets decreased. Now step 2 would be to replenish or reconcile your petty cash fund, and this is a little bit more complex. So let's say XYZ company reconciles the petty cash fund at the end of the month. Okay, and reconciling and replenishing are the same, basically the same thing. What you're doing is you're replenishing, you're putting the cash back in, and you're reconciling your receipts. There is $82 in cash on hand and receipts of $25 for postage and $80 in miscellaneous expenses. Now, I always recommend when you're replenishing or reconciling, you follow a 3-step process. Step number 1 is figure out how much cash you need to go back into the account. You have $82 in cash on hand. You want the fund to go back up to the original balance of $200. So 200 less the 82 means that we need $118 to go back into the fund. How are we going to get that? We're going to go ask the cashier to write us another check out of the general cash account. So general cash gets credited for $118. Step 1. Step 2, enter the receipts as debits. We have $25 in postage expense and $80 in miscellaneous expense. Okay, step 1 and step 2. And this can be very confusing to just read this problem and say, go reconcile and write the journal entry. But just keep it simple. Figure out how much cash you need, step 1. Step 2, enter the receipts as debits. Step 3 is to make sure debits equal credits. I've got $105 on my debit side and $118 on my credit side. That will not work. Okay, I am off by $13. Okay, that's going to go to this clearing account called the cash over and short account. It's a reconciling account. What it does is it tracks how many times or how often I'm over and short. Now, this account can be a debit or it can be a credit, depending on if you're over or short. In this case, we got receipts for $105, but we gave out $118. We did not get all the receipts back, or we didn't get all the change back into our petty cash drawer. So we were short by $13. If we were over, we would actually credit this account by the overage. So cash over and short can go either way. It can be a debit or a credit. It's a clearing account. And it's an internal control. It tracks how often we're over or short. In this case, if this petty cashier was short on a regular basis, we may want to have a talk, change the cashier, have regular audits. We may want to figure something out here. So here's a couple of notes. Number 1, petty cash is never adjusted. You don't see petty cash being adjusted here. Okay, it's not debited or credited unless you are permanently increasing or decreasing the account. So the cash gets replenished back from the general cash fund. And number 2, cash over or short is a control account and it can be debited or credited. Okay, so now you have your handout. You can pause the video and complete the handout, or you can just follow along. So ACC Company establishes a $300 petty cash fund on September 9th. On September 30th, the fund shows $100 in cash along with receipts for the following expenditures: transportation in, postage expense, and miscellaneous expense. WPACA uses a perpetual system in accounting for merchandise inventory. Prepare A, the September 9th entry to establish the fund. It's a $300 fund. Where does it come from? The general checking account. That gets decreased for $300. And then we start our brand new petty cash fund for $300. On September 30th, we're going to reimburse the fund. Okay, we're going to replenish it. This is the hard one. Start with 1. Step 1. Decrease cash for how much we need to put back in it. $300, the original fund, plus what's on hand, $100. So decrease general cash for $200. Then record the receipts. Transportation in. This is a hard one. Remember from chapter 4, transportation in goes to the inventory account. So we're going to debit merchandise inventory for $50. Postage expense, $75. and miscellaneous expense 70. Okay, add up our debits and credits. Our debits equal 195. So we need a $5 more to go into our debits. That goes to the cash over and short account. That's the difference between the credits and the sum of the debits. Okay. And step 3, we're going to increase the fund to $400. Now our fund already has $300 in it. So to increase it to $400, we're not going to make a journal entry for $400. We're going to make a journal entry for the difference. We're going to add $100 into the petty cash fund, and we're going to take it out of the general fund. We're going to go back to the bank with a check from the general cash account, and we're going to cash it for $100, and we're going to walk back to our drawer, and we're going to put $100 back into our lock box. Okay? These are the 3 journal entries. I know I went through them fast, but if you follow the rules, it's really pretty simple to work through these. Again, great exercise to do through flashcards. How do you establish a fund? Debit to petty cash, credit to cash. How do you reimburse it? Step 1, figure out how much cash you need. The original balance minus cash on hand. Step 2, record all the receipts to debits. Step 3, use that cash over and short for any shorts or overs. Okay, and then increasing the fund. Remember that we never adjust to petty cash unless we're permanently increasing or permanently decreasing the fund. Here we're permanently increasing debit petty cash and credit cash. Okay, bank reconciliations. This is the last thing that we're going to focus on, and bank reconciliations are step 1, or number 1, they're an internal control. We are checking what we wrote out and reconciling that to what the bank says we paid out. Okay. After the reconciliation, we want to make sure that our cash balance equals the bank balance. And how are we going to do that? We're going to prepare a reconciling worksheet. Now, I always like to use Cliff Notes here, so here's another good flashcard opportunity. Create a kind of a Cliff Note for yourself to say this is what a reconciling worksheet would look like. Okay, so we're going to start on the left side. We're going to start with the bank statement balance. We're going to add in deposits in transit. Deposits in transit are deposits that we made but have not yet cleared the bank. The bank doesn't show these deposits in the bank statement. Minus any outstanding checks. These are checks that we wrote but just haven't cleared the bank yet. So it'd be like you writing a check to your friend for $10. If the friend sits on it for a couple weeks, it's not going to show up in your bank. Okay, you take out any of those outstanding checks and you add or subtract any errors that were done on the bank's behalf. Sometimes banks make errors. They might transpose something. They might take something out of your account on accident. It was supposed to be out of a different customer's account. Banks make errors. So plus or minus any errors by the bank equals your adjusted bank balance. This is the left side. Again, really great flashcard opportunity. On the right side, you're going to do the company book balance. This is your general ledger balance. You're going to add in collections by the bank. What a collection by the bank would be for is if you had a note receivable out for a customer or someone else, an employee, whatever it would be. One good internal control would be to have the person write the checks directly to the bank. Then you make arrangements with the bank to open it up, process it, and put it right into your bank account. It's a really good internal control. Sometimes they're called lockbox transactions. So add in any collections by the bank, add in any interest earned on your account, take out any NSF checks. NSF checks are checks that were deposited by us, so it's our customer checks deposited that bounce. They were no good. So we take out any NSF checks, we take out any service fees, and plus or minus any errors by us, the company. When we're done, these two adjusted balances should equal. Okay. Again, I really encourage you, this chapter can be very easy if you get down the steps. So get down this bank reconciliation, put it on some flashcards, and just quiz yourself. Do you know how to reconcile the left side? Do you know how to reconcile the right side? If you get these down really good in your head, it's going to make this part of the chapter very simple. So let's look at an example. Let's prepare the bank, or the July 31st bank reconciliation for Simmons Company. Okay, and we can start reading, or what I always recommend is just put out our Cliff Notes. Here's our left side, the bank balance plus deposits in transit minus outstanding checks plus or minus errors by the bank equals our adjusted balance. And the right side, book balance plus collections plus interest minus NSF minus bank charges plus or minus our errors. Now we can go ahead and just go through all the steps and plug in where it goes. If you can get this down, the rest of it is just reading and figuring out, being a detective, where do these amounts go. So the first one, July 31st bank statement indicated a balance of $96.10. Okay, it's the bank balance. The cash general ledger account that on that date shows a balance of $74.30. Okay, remember that general ledger is our balance, but even if you didn't know that, you can figure this out at this point, right? So accounting, a lot of it's just problem solving. We can plug in what we know. The other side must be our book balance. Okay, number one says outstanding checks total $24.17. Well, that's outstanding checks right here, right? Number two, a $500 check mailed to the bank for a deposit had not yet reached the bank at the statement date. Okay, that's a deposit in transit, right? Number three, the bank returned a customer's NSF check for $225 received as payment on accounts receivable. Okay, NSF check. That goes over here, minus $225. Number four, the bank statement shows $30 interest earned during July. Interest earned. It's over here. I know I'm going through it fast, but if you get down this kind of Cliff Note version of the bank reconciliation, it's real easy to just walk through this and plug in where it goes. Check number 781 for supplies expense was cleared from the bank for $268, but was erroneously recorded in our books for $240. Okay, this was a mistake we made in our books. So whenever you see mistakes, just look for the difference, $268 versus $240. Okay, so the difference is $28. Is this added or subtracted from our side? Okay, and this takes students a little bit to get, but it says it was erroneously recorded in our books. We took it out of our register for $240. We should have taken out $268. So we want to take out the remaining $28. Okay, so it would be a subtraction. If we took out too much, we would want to add it back to our register. And number six, a $486 deposit by Acme was erroneously credited to our account by the bank. The bank made the error here. So it was deposited. It was another customer's deposit put into our bank account. We'd want to take that out. Okay. Now let's add up both sides and see if we equal. Okay, we're good. If there was a mistake, if you struggle on one of these bank reconciliations, what I always recommend is look at the errors. Flip them. See if maybe you should have added $28. Okay. All right, now you've got your handout. This would be a good time to pause the video and try it on your own, or you can just follow along. Okay, so let's prepare the bank reconciliation. Again, start with Cliff Notes. If you know your left side, bank balance plus deposits in transit minus outstanding checks plus or minus errors. The right side, book balance plus collections plus interest minus NSF minus bank charges plus or minus errors. Okay, if you have that ingrained in your head, then we can just read A through F and plug it in. Okay, so A, after posting is complete, the December 31st cash balance according to the accounting records. That's our balance, right? $3,800 goes down here on our side. The bank statement cash balance is $4,600. And again, if you were confused here, it very clearly states out bank statement balance is $4,600, so we would know that the $3,800 must be our side. Okay, B says check number 1282 for $400 is written and entered into the accounting records in December is not among the canceled checks. Check number 1231 for $300 is outstanding on the most recent November 30th reconciliation and it's not among the canceled checks. Both these checks have not been canceled. When we say canceled in bank statement terms, what we mean is that it's been cleared out by the bank. It's been processed by the bank. It is not canceled, meaning we canceled the check. It is canceled, meaning it's been processed. Okay, a couple of different terms going on in this chapter that you need to just get used to. So canceled does not mean we got rid of it. It means it's been cleared by the bank. So those are outstanding checks. Okay, so minus $700 for the outstanding check. C, when the December checks are compared with our records, it is found that check number 1267 has been correctly drawn for $350 to pay for office supplies, but was entered into our accounting records for $300. This is our error. Okay, we wrote a check for $350, but we just reduced our bank balance, or I'm sorry, our book balance by $300. So we have to take out $50 more. So that's errors by us. Letter D, 2 debit memorandum are enclosed with the statement and are unrecorded at the time of reconciliation. One debit memorandum is for $80 and dealt with an NSF check for $50 received from a customer, Titus Industries, and payment of his account. The bank assessed a $30 fee. Remember that friend that wrote you that bad check? Remember? This is a $30 fee that our bank slapped on us for the bad check. The second debit memorandum is $20 charge for check printing. Okay, so where do we record all these? We've got an NSF check of $50, a $30 charge for the NSF check, and a $20 charge for the printing. Okay. E, a credit memorandum indicates that the bank collected $1,000 cash on a note receivable and deducted a $10 collection fee. Okay, so we're going to go ahead and record the full $1,000 in collections and then take out the $10 here out of bank charges for the fee. Okay, and then finally F, Severino's 31st daily cash receipts of $740 were placed in the bank's night drop on that date but did not appear on the bank statement. Okay, that's a deposit in transit. It goes over here. Now we can add up the left and the right, and both of them equal $4640. Okay, one last note I want to say about banks. If you look here, we've got some terms called debit memorandums and credit memorandums. Now, in accounting, we know that accounting language, debit means add cash, credit means subtract cash. But on the bank side, it's flipped. When the bank sends us a debit memorandum, it doesn't mean increase our cash. It means we do the opposite. We decrease our cash. It's the banking and accounting are opposite. And I can tell you that the reason that is because from the bank's perspective, our cash accounts are liabilities. Okay, they are holding that cash for us. It is our cash. They are holding it. It's a liability. So when they send out debit and credit memorandums, it's the opposite. Okay, so when we see a debit memorandum on our side from the bank, we want to decrease. Okay, that's our decrease to NSFs. A credit memorandum means the bank collected cash and we're going to debit our cash. Many students that work at banks actually get really confused with by debits and credits, and that's why you need to just wipe out your prior knowledge. Here's where I can explain to you. You understand enough about liabilities now to understand that when a bank holds our money, it's a liability on the bank's behalf. All right, the last thing that we're going to talk about is journal entries. So we need to go ahead and make journal entries so that our current balance, $3,800, reflects all these changes and gets to the adjusted bank balance. Okay, so when we record all these entries, our adjusted balance is going to be $4640. I always recommend that students do 2 entries. Create a journal entry to increase cash and create a journal entry to decrease cash. So we have 1 entry that increases cash, the $1,000 for bank reconciliations. Okay. The other thing is that we do not need to record anything on the left side. Okay, that these items will clear on their own. We don't need to record them. If there was an error by the bank, we would get on the phone and call the bank and say, hey, you had an error, but we would not need to do anything on our side. We do need to record entries on the right side. And along with the Cliff Notes, the flashcards that I recommend you make, I always recommend just go ahead and next to your Cliff Notes, make a notation of where that adjustment would go. For example, this collections always gets recorded in notes receivable. Interest earned always gets recorded to interest revenue. In this case, we didn't have any, but I wanted you to just note that. NSF checks and their fees go back to accounts receivable. We're going to charge that back to our customer, so we increase the customer's, in this case Titus's, accounts receivable balance. Bank charges just go to miscellaneous expense. Overall, they're typically not, even the annual charges are not very much, so we just record them to a miscellaneous expense. And then errors are the only ones that I can't tell you with certainty this goes to this account, because you have to read the problem and see this, the company made this error and it was originally for electricity, or in this case it was for supplies. Okay, so when you're making your Cliff Notes, just go ahead and collections dash notes receivable, interest earns collection, or sorry, interest earned dash interest revenue. NSF dash accounts receivable, or parentheses accounts receivable. Bank charges, parentheses miscellaneous. Errors by the bank, just put a little question mark. That way it's real easy to make the journal entries because you already know where the amounts are going to go, where these adjustments are going to go. All right, so here's a journal entry. Remember, the $1,000 increased our cash, so we debit cash for $1,000. And if we look back, remember that went to the notes receivable account. So debit to cash, credit to notes receivable. Okay, and we didn't have any interest, and that should say revenue, sorry. We didn't have any interest, so we're just going to leave that blank. Okay. Then I just want to peek back here and say, okay, what decreased our cash? We had this NSF, and remember we're going to charge the customer for not only the check, but also the fee. So we're going to put back the whole accounts receivable for $80. Bank charges, $30 goes to miscellaneous expense. And then remember that this is a question mark, but we know it went to supplies. If you read through the problem, it went to supplies. So all in all, we have 80 plus 30 plus 50. So what is that? $160 decrease in cash. Okay. So cash is decreased by $160. The accounts receivable balance gets increased for both the NSF and the NSF fee. We record a debit to supplies and a debit to miscellaneous expense. Okay. So one entry to increase cash, one entry to decrease cash. And you just, if you've got your Cliff Notes, you know exactly where those adjustments go. Except for the errors, you need to put a little question mark there because you've got to read through the problem. And the other thing that I just want to make certain that you understand is that NSF charges, both the NSF check plus the fee goes to accounts receivable. Because again, what we're doing is just like charging a friend for the $10 that they wrote you plus the fee. All we're doing is we're saying, hey customer, we're going to increase your accounts receivable balance for both the check that bounced and the fee. Okay, I know this was a quick chapter. I went through these demonstrations pretty quickly, but again, there's not too much to say. If you get down the formats, if you get down your flashcards, your petty cash rules, the bank reconciliation, Cliff Notes, if you get those down, the chapter's not too bad. Make sure that you do read the entire chapter. If you have any struggles with this chapter, seek help from myself during office hours or the tutoring center. This is the last chapter before the next exam. So make sure that you do read through this and spend enough time practicing through this chapter so that the exam preparation won't be so bad. All right, have a wonderful day.